US stock markets resumed their recent downtrend since early this week as a better-than-expected US jobs report and improved services activity boosted the dollar and weighed negatively on equities. Furthermore, yesterday a series of CEOs from top Wall Street banking institutions sounded the alarm bell over an impending recession in the US economy going into 2023, which prompted traders to reconsider their bets. In this report, we aim to present the recent fundamental and economic news releases that impacted the US stock markets, look ahead at the upcoming events that could affect their performance, and conclude with a technical analysis. During yesterday's session, a chorus of US bankers unleashed havoc in the markets, placing significant pressure on the US equity sector as they underscored the dangers of persistently elevated inflationary pressures can have detrimental effects on the purchasing power of consumers. Furthermore, they also highlighted their concerns in regards to the effects of the over-tightening efforts by the Fed to contain the inflationary problem and alluded that the US economy may start showing signs of severe slowdown. More specifically, JP Morgan Chase CEO Jamie Dimon alluded that a mild to high recession may hit the US economy next year, while Goldman Sachs CEO David Solomon warned about mass layoffs and salary cuts as he sees some bumpy times ahead. All three major indices, namely the Dow Jones, Nasdaq 100 and S&P 500, slumped instantly, closing the day in the reds. Needless to say, investors' confidence may shake in following the grim comments and prompted a large portion of market participants to opt for a risk-off approach, spurring a widespread sell-off on US equities. Finally, looking forward, we expect stock market traders to maintain a risk-cautious attitude, being hesitant on placing any big bets as we close in the Fed's interest rate decision next week. Should the market cautiousness intensify, we may see the greenback enjoying more safe haven inflows, while US stock markets sliding lower. Last Friday, the highly anticipated US employment report posted better than expected results that hinted the US labor market remains resilient and healthy, withstanding the adverse effects of the Fed's aggressive stance in a period of projected economic slowdown. More specifically, the non-farm payrolls figure rose more than expected to 261K for the month of November, exceeding market consensus of 200K. The unemployment rate recorded no change, remaining steady at 3.7%, and average earnings recorded an increase to 0.6%, higher than the 0.3% estimates. Overall, the results suggested that the US economy remained robust in the month of November, causing market participants to downshift their bets for a policy pivot. As a result, allude that the Fed may continue going forth aggressively with its monetary tightening practices in an attempt to tame inflationary pressures. Furthermore, on Monday, the release of the ISM non-manufacturing PMI recorded an unexpected increase to 56.5 in November, exceeding forecasts for a slowdown to the 53.3 level. The results particularly indicated a pickup of the activity in the US services industry, marking a rebound from its lowest levels for the year and fueled expectation for higher interest rate from the Fed than recently projected. Both results, in essence, put a floor under the dollar, which has been underperforming for the past 2 weeks, and put pressure on the US stock markets, setting an end to the respectively winning streak. Look ahead, traders' attention turns towards the inflationary print expected to land next Tuesday, providing a status update of inflationary pressures in the US as well as the highly anticipated Fed's interest rate decision scheduled on Wednesday, alongside the renewed dot plot projections for next year. Thank you for watching.